Well, hello everybody. Do you know the number one way or thing that scares people about retirement? Now, it's probably not what you think it is. It's not about being bored or not knowing what to do or even dying. It's according to Market Watch, it's the number one thing that people fear most. It's running out of money in retirement. It's being 80 years old, full of life, chock broke, and nobody really wants to be in that position. Welcome to this week's Market Huddle. I'm Joe Lucey, Secure Retirement Financial, and thanks for joining us here today. Today, what we're going to be discussing is 5 simple strategies that can keep you from going broke in retirement. Now, of course, the only way that you can avoid being broke in retirement is to have income, right? Well, you need income in retirement that comes in like clockwork. It needs to come from different sources. And while that's never been easy, this recent pandemic, the fallout that we've gone through, it's made it a lot more challenging than ever before. We've got interest rates on CDs and savings accounts that are literally 0% today. Investing in the stock market comes with more risk today than it did even just a month or two ago. And extra trillions of dollars in stimulus probably means more taxes down the road, which is going to leave a whole lot less money for us in our retirement years. And unless you have a strategy to successfully overcome these challenges, well, retirement can be a whole lot harder. So coming up on this week's Market Huddle, we're going to be talking about 5 strategies that can help you bring your retirement planning full circle and make sure that we don't go broke. So with that said, let me get the presentation here started. And hopefully you all see this. I'll take the video off here for a little bit. But today we're talking about the 5 simple things or strategies that can help you from going broke. This right here is a disclaimer that we are going to talk about now. Specifically, even this week, we're going to be talking about taxes. I'm going to be talking about how to help us protect ourselves from that, or things to start thinking about. And it's important to reiterate that I am not a accountant. I'm not a CPA. I am a certified financial planner. I've been doing this for 26 years, and we've helped thousands of families around the Twin Cities. Many of you are currently clients of ours. Some of you are joining us here for the first time because you have maybe been receiving some of these emails since we started these back on March 23rd, right in the middle of the coronavirus, when everybody started going home. And some of you have even been invited to this from maybe an existing client of ours. So I want to welcome everybody to this week's Market Huddle. But understand, I'm a CPA. I've been doing this for since 1994. I think that puts me at 26 plus years. We are a mature office here in St. Louis Park. And well, let's get right to it. 5 simple strategies to make sure that we don't go broke in retirement. The first strategy that I wanted to talk about here today is that we need to make sure that we are optimizing our Social Security benefits. When it comes to Social Security, you need to make sure you get every nickel that is rightfully yours. In our office, we oftentimes talk about the foundation of an income plan is what I call mailbox income. Now, mailbox income is money that hits the checkbook each and every month, regardless of what's going on in Wall Street. It's money that comes into the account, and when the account balances drop that are in investments, I know that I can confidently withdraw that money and not sacrifice giving up potential returns on that money like I would if everything was in the 401k. Social Security is really important. According to USA Today, Social Security has been referred to as the near perfect source of retirement income. Now, that's from the Stanford Center for Longevity. And there's a few simple reasons for that, including the fact that you'll never have to worry about running out of money during your lifetime. Forbes says Social Security functions as a $1.5 million annuity for many people entering retirement, and that it needs to be considered the foundation of your income plan. Now, The good news is this: even if you have earned a modest income throughout your career, Social Security benefits can add up easily to six figures in retirement. If you've earned an above average income, the benefits can be several hundreds of thousands of dollars. So it's really critical that we look at how to bring in Social Security benefits into a retirement plan. I often talk about here at Secure Retirement Financial, the investment strategies, whether or not I should be buying this mutual fund or that mutual fund or this investment manager or that investment manager, is different than having an income plan. Income plan is different from the investment strategies. Now, both are important. But you need to make sure that you can learn how to take your money back in retirement, take it back tax efficiently, make sure it lasts a lifetime, and that has to go beyond just wealth increasing or wealth management strategies. Now, according to USA Today, now this is just from July 4th, the problem comes with the fact that Social Security is a confusing program. And simple mistakes around the decisions you make with your Social Security can end up costing you a fortune. Now, Bloomberg tells us that 96% of all hardworking Americans are actually losing money. They are not optimizing their Social Security benefits. It comes from a variety of reasons. But of the 96% of hardworking Americans that are making the mistakes, the average mistake is costing them $111,000 of future income. Now, even if you've done quite well in your retirement and retirement planning, $111,000 can go a whole long ways towards making sure that your money lasts as long as you do. Mistakes around Social Security end up costing the average retiree a ton of money. Now, the other thing is that if you're joining us here today, it's very likely that you have done some planning for your retirement. Not everybody that comes in our office or joins us here has done that, but I know that the average person joining our webinars, taking some time out of your day, has done better than many of our neighbors when it comes to retirement planning. And the problem with this is this: traditional rules around Social Security probably don't even apply to you. This waiting as long as possible to maximize it or to take it as soon as possible probably is not the best way to think about your Social Security. See, Social Security, you got to think of it as a net planning. It's not so much what the dollar amount is, but what the dollar amount is after taxes. Social Security income can be one of the most tax efficient incomes we have. But when I start looking at what other income can do to the Social Security and the taxes there, or maybe my Medicare premiums, you need to really be looking at a full approach. Now, at the end of today's Market Huddle, we're going to be offering an opportunity. If you are not sure that you have made the right decisions around Social Security, I invite you to schedule 15 minutes with one of our advisors here. Let's spend a few minutes. Again, this is open to those of you that are current clients. If we need to review your planning, let's do that. Now's a great time to do that. If you have maybe joined us here for the first time, or maybe you've been on every one of our Market Huddles that we've been doing here going back to March, I encourage you to schedule 15 minutes with us. Let's sit down. Let's talk about the number one thing that you're concerned about. My goal during these calls is to find the number one action step that you can take today to make a significant improvement in your retirement planning. And so I encourage you to do that. And I know many of you have just received or been invited to this from somebody that might already be working with us. So if that's the case, schedule 15 minutes. What is it going to hurt? That you leave the checkbook at home. It's about making sure that we're getting you some good advice that makes sense for you. And the one area that I want to make sure that of the 5 simple strategies we're talking about to make sure you don't go broke in retirement, you got to get Social Security right. It's the foundation of mailbox income. Let's move on to the number 2 area. And that's making sure that we have a look forward tax plan. Now, one of the fastest ways that I know that you can get more income in your retirement is by reducing taxes. Most people can probably tell us about how much they've set aside for retirement. When somebody comes in our office for the first time, I'll say, how much have you set aside? They can generally give us an idea. But when it comes to how much they're going to be paying taxes on that money, many of them have no clue. And that can be, in my opinion, downright dangerous. Now, Think Advisor, one of the industry threads we look at, says a third of all retirement investors have not considered the effects of taxes on their planning. Now, this is from a study just back in June of this year. So June 30th is actually the day of the study. What you might not be thinking about can end up haunting you. It's about how taxes will affect your retirement income. Again, it's not just about the investment strategies. It's how do I take this money back? How do I make it last a lifetime? How do I do it tax efficiently? The Harris poll tells us, a nationwide retirement institute tells us that 35% of all Americans who are retired or expect to retire over the next 10 years have not considered their tax planning. And I think that that can be dangerous. Now, what the reason for this is this. Really, most Americans, we think of preparing our taxes and filing our taxes. We confuse it to what I'm talking about here, but that is tax preparation. What I'm really talking about is look forward tax planning. We got to be looking forward, not backwards, when it comes to our retirement planning. And now may be more critical than any other time that I can think of, because we have gone to a point where we have borrowed multiple trillions of dollars of money to help stimulate the economy through the coronavirus here. And this money has been borrowed at a rate faster than we have ever seen. Now, what that really means is this. Where few months ago, I was pretty certain that we would see an increase in tax rates. I can say it now with a whole lot more confidence that it's very likely that as we start to look forward, we're going to have to see an increase in taxes. Now, when is that going to occur? Well, we know that based on the current tax plan that was passed 2 years ago, that come January 1st of 2026 or December 31st, 2025, I guess that's really the official date, the tax rates are, by law, what they said it when they passed the tax rates was that they would go back to where we were prior to this. Now, I personally am afraid that we're going to see taxes go up even higher than where we were a couple years ago. And again, that has to do with the additional, we're talking $2 to $3 trillion of additional stimulus that's been put into the economy here. Again, well needed probably to get us through this that we're going through. But that's going to have some consequences. It's like having an extra glass of wine before you go to bed at night. You might wake up with a headache. I'm pretty sure this headache is going to be coming back. And what we're really talking about here on today's Market Huddle is about how to generate more income in retirement. And if you have an IRA or a 401k, we oftentimes think of this as all our money, but it's really just a joint account. It's a joint account between you and the IRS. And what we want to do is make sure that if you're joining us here today, that we look at some defensive tax planning strategies that you can be doing right now. It's a great time. I mean, we're right here in the middle of July. Let's find some time to look at some strategies that you can employ. Some of them are simple. Some of them might be a little bit more complex. We may have to bring in your accountants and what have you, but now is a great time to be doing that. We've got a lot of great things going on. We have tax rates at lowest rates we've seen. We also have a little bit more certainty that they'll probably be going higher, so we can make some changes with our look forward planning a little easier emotionally than maybe what we could have in the past when we weren't as sure. So bringing together the investments and the taxes and making sure we got smart decisions around Social Security, these are all different ways that we can make sure that we are looking at 5 simple strategies that can keep you from going broke in retirement. What's number 3? Number 3 is to make sure that we are protecting our purchasing power. Now, Ronald Reagan called inflation a stealth tax, said that the number one way that we would see, one of the number one fears or risks in retirement is this inflation and what Ronald Reagan called the silent killer. It's a kind of a situation where 1%, 2%, 3%, it doesn't seem like a lot when it's going on, but it really starts to add up. Now, the worst part is this. In today's low interest environment, when it's really hard to get any kind of return from our bank accounts or from our savings accounts or even bonds, the risk of losing buying power is even greater. Barron's recently is telling us that the Fed anticipates interest rates at near 0% for at least through 2022. Now, there's no real surprise here, but because interest rates are at these record lows and have been for decades, it makes it virtually impossible for somebody that's in retirement to get the returns that they need to keep up with inflation from just traditional sources of safe money like CDs or savings accounts. So what happens is that many of us are starting to take more risk, and this can be a dangerous game as you start to get there. Now, there's some good news, and that's that there are some attractive opportunities that we can help you generate income. In fact, we'll probably do a whole presentation just around that here in the next few weeks. But if you are concerned about inflation, again, we're going to be offering everybody the opportunity to schedule some time here in just a few minutes. Let's talk about expecting longevity. This is the fourth, as we talk about the 5 simple strategies to keep you from going broke. We talked about making sure that we're maximizing or optimizing Social Security, taxes, protecting our purchasing power. The fourth is that you need to make sure that you are expecting to live longer. Running out of money before you die is one of the biggest concerns of retirees. They tell us that 3 out of 4 of us, that's the biggest concern we go into retirement. And now with the advent of medicine and better technology and what have you, it used to be that you could plan to age 95. And even now, I think you need to start planning on possibly living past that age. Now, some folks tell me, boy, Joe, I don't ever want to live to 100. But the centenarian is a term that they call somebody that's reached their 100th age. And we have seen a skyrocketing in the number of people doing that. In fact, if you're 65 today, if you're a married couple, both husband and wife, and you're both 65, there's a 50%, it's a 50-50 chance that one of you is going to live past the age of 92. In fact, it's a 1 in 4 chance that one of you will see the age of 96. And what that really means is that we have to start thinking about our retirement years lasting even longer. One of the stress tests that we do with every client that comes in is we talk about making sure that, God forbid, we both live to 120. Do we have enough there? And once we can get past that point, well, then, sometimes what we want to do is we want to see what would happen if Martians took one of us away and that I've got a surviving spouse. Is my surviving spouse going to be able to live to that older age? Could they be a centenarian and have enough? What's really important around when we start thinking about longevity is, number one, we need to make sure that we're stress testing our income plan. An income plan has to be mathematically, statistically, historically tested to make sure that in all situations, there's going to be enough to protect us from longevity. And the risk is really this. See, longevity has a snowball effect. The longer you live means that there's going to be more expenses that start to pile up. You also have a greater probability of experiencing more market volatility or even multiple market volatility type crashes. More money you're going to need for ongoing healthcare expenses. Longer you live, the more likely you're going to need long-term care. Differences in administrations, differences in regulatory changes. All of these different inflation, we talked about that earlier. We need to make sure that we're looking at longevity. Making sure we're looking at longevity and how it plays into making sure we're going to protect our buying power, making sure that we have enough mailbox income, maximizing Social Security, our first point, even making sure that we are doing everything we can to proactively reduce our tax burden over time. Lots of different things we want to be doing when it comes to putting together a comprehensive plan. Now, there's the fifth thing, and that's making sure we manage the risk. I know that some of you might have even thought that this is where I was going to start the presentation today, but it is important that, as I said, the investments, the strategies, while they're important in retirement, having an outlook on your taxes and investments is just as important. In other words, if you're sitting down with an advisor, the discussion should not be only, what am I doing with this investment or this investment? It should be more proactive. How do I reduce taxes? How do I make sure my money is going to last long enough? And then the most important thing, when you think of your retirement, how much is needed to be risked to get you across home plate? A lot of times I think that advisors focus only on what's the pure returns. And now Those of us that were working in that world alone, we felt a little bit more pain as we went into the coronavirus shutdown. Now that we're coming out of it, the markets have, for the most part, started to feel a little bit better. Now is a great time to look at risks. Now, I'm going to turn on the mic again here, but there's really three risks. There's the risk you need. That goes to the protecting the buying power. You need to make sure that you are taking enough risk or getting enough return in this low interest rate environment to protect the purchasing power and protect it for longevity. But also we need to be looking at risk capacity. Now, risk capacity is a mathematical number. It has nothing to do with your comfort level with risk. It really has to do with, if I've set aside so much money, if I've got $1 million, how much of that can I lose and still maintain my lifestyle? I've been doing this for 26 years. I said it earlier. Nobody I've ever worked with has said, Joe, show me how to cut back on my lifestyle so I can make my savings work for me. We say, hey, Joe, how do I take the savings and make sure I've always got enough in my lifestyle, get enough income? So we got to make sure that we never get to a point where there's a market pullback due to coronavirus or whatever next elections or interest rates going up or inflation. There's a lot of different, just the national debt getting to a certain point. A lot of different things can do that all of a sudden the market's going to have volatility. We're seeing more now than we've seen for going on like 12 years. So let's make sure that we're not taking on more risk than we should. If you're 95 years old, you should be able to look back at your life and say, Joe, I was always able to go out with the family. We had these big celebrations. We went out to dinner. I always cut the check. I was never looking for one of the kids to go Dutch with me or anything like that. But on the other hand, don't take so much risk, because if you need a 5% return to get your goals and you're taking 7, it could mean a higher you might be risking your risk capacity. Again, there's 3 risks: risk needed, risk required, making sure we got inflation covered. Number 2 is make risk capacity. It's a mathematical number. How much can I lose and still maintain my lifestyle? And then the third is that behavioral risk loss or risk tolerance. A lot of us think about that. You should never have a point in your retirement planning where you are unable to look at your statements. I know many of our clients, that was one of the things that we heard more than anything else. Joe, nobody likes to lose money. Nobody likes to lose it fast. But as long as we know that we've got a plan in place and that the money that pulled back was for wealth accumulation, most of our clients told us, Joe, how much they appreciated making sure that they had their risk under control. So if you're a current client and we need to review that, let's schedule some time. If you are joining us here and you've been watching these and I'm not sure, give us a call. Here, I'm going to show you how we can do that right now. And if you are somebody that was invited to this from one of our other clients, I encourage you, schedule the 15 minutes. Again, the idea on this call is really simple. We just want to find the number one action step you can take today to make an improvement in the direction of your retirement planning. Whether that involves us or maybe just answering the short question. Sometimes it's just by reviewing one simple area, such as Social Security, getting you a plan in place so you get that right. That's what we want to do. Remember, there were 5 areas that we wanted to focus on here today. Wanted to focus on, and the 5 areas is to make sure that we don't go broke in retirement. You need to be looking at taxes. Let's have a look forward tax plan. Number 2, let's make sure that we are addressing or optimizing our Social Security. Let's get that right. Let's make sure that we are looking at longevity and how that plays into things. Let's make sure that we are protecting our purchasing power, that our money's going to last as long as we do, and the buying power. This whole concept of having a fixed income, I think that's old. We want to make sure that as inflation grows, our income's going to grow with it, so we don't have to be, we want to live a life of abundance. We don't want to be sacrificing, and making sure we put in planning for inflation and the loss of buying power potentially down the road is very important. And then finally, just understand those 3 risks. Let's make sure we don't fall in the track of taking too much risk early in retirement. It's the worst time you can have losses. Nobody likes to lose money, as I said earlier, but somebody that's in their 60s and loses a significant portion of their savings, that impacts them a whole lot more than somebody that's closer or farther down on the longevity scale at 95 and they were to lose somebody at first sample. So anyways, we can review this with you. Schedule the 15-minute review. With that said, I hope everybody enjoys the rest of their week. Today has been July 20th, and we're here if you need us. So don't hesitate to reach out and schedule your call with one of us here at Secure Retirement Financial. Have a great rest of your week. Thank you much.